My main focus point today concerns an important topic, and that is a mid-year market outlook. Now, a recent report dives into, given that we are already almost all the way through June, what to expect for the second half of 2025. So let's get to those highlights right now. Number one, tariff uncertainty will continue to be an overhang on markets. And this comes in many facets, right? At one side, you're seeing investors' reactions are softening. Why? Because implementation keeps getting postponed and postponed and postponed. But at the same time, you have hard economic data. You have companies that are not investing as they would with that type of uncertainty. And so the effects of this tariff uncertainty can affect the real economy and the financial economy a little bit differently. Another is the Fed is expected to cut rates 1 to 2 times. Why? Because inflation risks seem to be ebbing a bit, but also the labor market is quickly deteriorating. You see that in the continuing claims data, the most recent continuing claims data. And so tomorrow should give us a little bit more clarity. Is it going to be 1? Is it going to be 2 times? Is it going to be no times? Who knows? We'll see. Another is that the U.S. economic market outlook is clouded by high valuations, right? You have companies that are a bit stretched, pricing in some significant earnings growth still, in spite of everything that's happening. You have, as I mentioned, that cooling labor data. You also have that overhang from fiscal policy concerns. A big, beautiful bill that the CBO now updated, expecting to add $2.8 trillion to the deficit over the next 10 years. What's that going to do to equity markets? What's that going to do to the cost of financing debt, the bond market? All of these things, important parts of the second half of this year. Now, year to date, international stocks have outperformed US stocks in spite of the US comeback. And so because of this, Schwab, and we agree, is urging a reevaluation of global diversification, something that many investors didn't really suffer from not doing within their portfolios over the past decade. Now, I already hit on this point, but I'll do it again because it's incredibly important. Fixed income markets are becoming very volatile. Yields on treasuries, longer dated treasuries, are trading not in a way that we've seen bonds trade in quite some time. And so because of this report agrees with us that if you want to invest in fixed income, keep it on the shorter duration side. Especially because for a lot of people, right, if you look at the yields on shorter term treasuries, you're getting in the 4 to 5% range. And that's a very attractive yield in a time when equity markets are more volatile, valuations may be stretched, there is a lot of fiscal overhang, a lot of issues potentially on the horizon. Another key, again, I already touched on it a bit, but US deficit may hit 7% of GDP if current legislation passes. What does that mean practically? Yes, it's a big number, trillions and trillions of dollars, but there is a finite amount of lendable capital, if you will, right? And you have this crowding out effect. As the US government continues to borrow more and more, it means there is less to be borrowed by private enterprise. It means the cost of borrowing by private enterprise becomes more as the benchmark rate for the government rises. This will be an incredibly important trend for the second half of this year and really the next decade. And with what we've seen, rising tensions in the Middle East, tariffs that could frankly be implemented at any point in time, inflation protection strategies like having cash buffers, staying invested, because equities tend to give you a good buffer against inflation over time, and Treasury inflation protected securities or TIPS remain an essential part of any investor's portfolio. If you're in retirement, you should be more heavily allocated towards bonds, but your primary concern is not just maintaining capital, but maintaining the spending power of that capital. And so focusing on investing in TIPS can really be of benefit to you as you draw down from your assets. Lastly, regardless of policy outcomes, tax-aware planning is necessary. Understand your financial situation. Understand what beneficial options are open to you. Be it traditional IRAs, the tax advantages there. Be it the tax-free growth from Roth IRAs, the tax benefits of ETFs, the For high net worth investors, tax benefits of being invested in municipal bonds. In order to best prepare for your future, it's incredibly important to understand your financial situation, and that is always relevant on the tax side as well. Nobody can predict what is going to happen in the second half of 2025. Certainly, nobody predicted what's happened in the first half, but understanding some of the things they highlight in this report can give you a better idea and help you plan better for the rest of 2025.